Most employees notice that a large portion of their hard-earned paycheck disappears into taxes every month, leaving them frustrated and wondering where their money goes. 14. Payroll tax, federal and state income tax, and social security contributions combine to dramatically reduce, even with careful budgeting. Mandatory deductions from each paycheck make it difficult for employees to save or invest for the future. Compared to investors, employees typically pay a higher percentage of their income in taxes, which creates a noticeable disadvantage over time. Understanding why taxes hit employees harder than investors is crucial for maximizing financial potential and planning for long-term growth. Payer income is taxed through multiple layers, including federal, state, Social Security, and Medicare, quickly reducing the amount that actually reaches an employee's bank account. Every paycheck loses a portion to mandatory taxes before it reaches the individual, making it harder to save, invest, or grow wealth steadily. Meanwhile, investors are taxed differently, often paying lower rates on capital gains and dividends, which allows their wealth to grow faster over time. This difference explains why employees often feel overburdened by taxes, while investors enjoy significant advantages in building long-term wealth. By understanding these differences, employees can begin planning strategies to optimize finances and legally reduce their tax burden. Payroll taxes are a significant part of what employees pay, including Social Security and Medicare, which are taken out automatically from every paycheck. Federal income tax rates rise as salaries increase, meaning higher earners pay a larger percentage of their income. State and local taxes further reduce what employees actually take home, creating a compounding effect that can feel overwhelming. Many employees rely on accountants or tax software to navigate the complex tax system, adding cost and stress to their financial routine. Mandatory deductions leave employees with significantly less disposable income, limiting their ability to save, invest, or enjoy financial freedom. These mandatory deductions leave employees with significantly less disposable income, limiting their ability to save, invest. The difference between gross and net income highlights the real impact of taxation on employees' financial situation. Over the course of a year, the cumulative effect of these deductions amounts to thousands of dollars that employees could otherwise invested or saved. High taxes contribute to financial stress, limiting lifestyle choices and the ability to plan for emergencies or major life goals. Despite careful budgeting, employees often feel their hard work is undermined by the sheer amount of income that goes directly to taxes each month. Investors operate under a different system, often paying taxes on profits at lower rates, particularly for long-term capital gains, allowing wealth to grow faster. Total gains from stocks, real estate, or businesses are frequently taxed at rates lower than payroll taxes, which incentivizes investing over earning a salary. Short-term gains are taxed more heavily than long-term gains, but even short-term capital gains often carry a lower effective rate than salary income taxes. Dividends and interest income often benefit from preferential tax rates, further increasing investors' net returns compared to employees. Overall, investors pay a smaller percentage of their total income in taxes, which creates a financial advantage over employees relying solely on salaries. Lower taxes allow investors to reinvest more of their earnings, taking advantage of compound growth over time and building significant wealth. By reinvesting profits instead of losing them to high taxes, investors grow their capital much faster. Over decades, this difference accumulates, creating a substantial gap between the wealth of investors and employees. Investors also have access to legal strategies and tax planning tools that reduce their effective tax rate, further widening the gap. Effective tax rates clearly show that employees bear a heavier tax burden relative to their income compared to investors. Salary income is taxed immediately and heavily, leaving little room for employees to retain and grow wealth efficiently. Investors can take advantage of tax-deferred accounts like IRAs and 401ks, postponing or reducing taxes legally while their money grows. The difference between salary taxes and investment taxes is one of the main reasons investors accumulate wealth faster than employees with similar earnings. Employees may work equally hard, but see a much larger portion of their income go to taxes, while investors enjoy compounding returns. Payroll and income taxes take a direct and immediate portion of earnings, limiting the ability to invest and grow wealth. Investors often have access to deductions, credits, and lower rates legally, further reducing their effective tax burden compared to employees. This comparison makes it clear why employees often feel overtaxed, while investors benefit from structural advantages in the tax system. The ability to reinvest more after taxes allows investors to benefit from compound growth, accelerating wealth accumulation. High taxes make it challenging for employees to achieve financial freedom quickly, even with disciplined saving and budgeting. Investors, on the other hand, see their money grow faster, providing more options, security, and lifestyle flexibility over time. Taxes collected from employees fund essential public services, but the burden falls more heavily on salary earners than on investors, who often pay less proportionally. Progressive tax rates increase as employees earn more, meaning higher earners contribute a significantly larger portion of their salary compared to investment income. Combining federal, state, local, and payroll taxes creates a heavy financial load that can feel overwhelming for the average worker. Investors, however, can structure their finances to minimize taxes legally, allowing more money to stay invested and grow over time. The timing of taxes favors investors because they can defer taxes on gains, unlike employees whose income is taxed as soon as it is earned. Employees have limited options to reduce taxable income, whereas investors can access deductions, credits. Despite earning a decent salary, employees often see a much smaller portion reach their bank account, leaving little for saving or investment. Investors can reinvest the portion of income that isn't heavily taxed, allowing compounding to work in their favor over the years. Over time, the difference between employee and investor wealth grows exponentially due to lower taxes and compounding returns. High taxes make it challenging for employees to save, plan for emergencies, or achieve long-term financial freedom. Investors often work with financial advisors to legally minimize taxes and structure their portfolio for maximum growth and efficiency. Retirement accounts like 401ks, IRAs, and Roth IRAs allow investors to defer or reduce taxes while their money compounds over time. Effective tax rates highlight that employees pay more of their income in taxes compared to investors, even if their total earnings are similar. Employees struggle to grow wealth due to high taxes, while investors see their wealth accumulate faster through strategic investing and lower taxes. Each month, salary income is reduced by mandatory taxes, limiting what employees can put aside for future goals. Investors benefit from compounding because they pay less tax upfront, leaving more money invested and growing over time. Over a decade, even modest investments grow much faster than employee savings due to lower taxation and reinvestment of profits. High taxation limits the ability of employees to build wealth and forces careful budgeting to meet financial goals. Investors experience financial freedom earlier because less of their income is lost to taxes, allowing them to focus on wealth creation. Balanced taxation heavily favors investors, making it easier for them to accumulate wealth over time compared to employees. Media payroll taxes reduce net income for employees, while investors can defer or reduce taxes on gains, giving them more financial flexibility. Planning investments strategically allows investors to legally minimize tax exposure and maximize wealth accumulation efficiently. Over a working lifetime, employees often pay significantly more in taxes than investors with similar or even higher total earnings. High taxes create stress and limit the ability of employees to invest or save for emergencies, retirement, or big life goals. Lower taxes allow investors to focus on long-term growth, giving them more freedom, security, and lifestyle options. Employees face slower wealth accumulation due to high taxes, while investors can accelerate their growth with strategic investing. The tax system favors investment income, explaining why investors often achieve significant wealth compared to employees earning similar amounts. High employee taxes force careful budgeting, but even disciplined saving is limited by the portion of income lost to taxation. Investors benefit from compound growth and tax advantages, which allow their wealth to expand faster than employees relying solely on salaries. This clear comparison highlights how employees are taxed more heavily, and why investors accumulate wealth more efficiently. High taxes make achieving financial freedom a slower and more challenging process for employees compared to investors. Investors gain flexibility and more rapid wealth accumulation due to lower effective taxation and strategic reinvestment. In summary, the tax system is structured in a way that favors investors, while employees bear a heavier load of taxation on their income. Understanding these differences is essential for financial planning, allowing employees to make smarter decisions and potentially reduce their tax burden legally. By learning the system and making strategic choices, employees can also optimize their finances and build wealth over time, despite higher taxes. Thanks for watching. We hope you learned something valuable about taxes and investments today. Don't forget to subscribe to our channel for more tips on financial growth and smart investing.